it looks from the outside like the interest rate sensitivity of the economy in this cycle has been very muted, very different than in the past. There's also, you look at the economy, they look like there's very differential impacts across different parts of the economy. The housing market, people have long-term fixed-rate mortgages, so interest rate pass-through there is very low. Here in Silicon Valley, we have early-stage growth businesses where the cost of capital is affected by the higher rates, and there it looks like we have a much bigger impact. So I wonder if you can speak about the interest rate sensitivity of the economy in this cycle. And then another question, a related question, which is we have differential impact across the economy. How do you think about balancing the impact of interest rate hikes on different sectors?
So I guess the headline for me would be that I do think monetary policy is working and working broadly as expected. I think you can point to sectors of the economy, and you mentioned a couple. So if you're a household that has a low-interest mortgage, you're not feeling the effect of higher mortgage rates. And many companies as well took the opportunity to term out their debt before rates went up. So you have a lot of companies that have longer-term fixed-rate debt at pretty low rates, and they're not as affected by it. That's all true. At the same time, again, if you look at interest-sensitive spending, either in housing or durable goods, you're seeing very significant effects there. And I do think you see the economy rebalancing. So I think it's not right and maybe too soon to conclude that there's some significant disconnect there in terms of monetary policy transmission. But it still leaves the question of how the economy can have grown over 3% during a year in which the federal funds rate is at a quarter-century high. Why wouldn't growth have been lower? And to me, the answer to that is the supply-side recovery. I think that's what people need to understand, is that you have this force from outside. It's not just interest rates and demand. You've got a supply-side recovery that is creating new demand and new supply. And that's why you get a number like 3.1% at the same time inflation is coming down. One of the reasons why. So I think that's really the story. It's not that the policy isn't restrictive, and it's not that the economy is not responsive to rates. It's that we've had this outside force that is temporarily affecting that.
So if I benchmark Fed policy right now, we have rates at 5.3%. Inflation is running a little bit under 3%. That's like a 2.5% real interest rate. That's really the real cost of borrowing. Compare this to pre-pandemic. We had real rates of close to 0, maybe 0.5%, sometimes negative. So we've gone from a very low rate environment to a very high rate environment. Policy looks tight right now. Another benchmark, I don't know if my colleague John Taylor is here, but the Taylor rule is a typical benchmark we use for thinking about a central bank policy. And by the Taylor rule, policy rates right now should be around 4. So policy does look quite restrictive right now. And I think in talking about where policy is right now, you've said that the risks are balanced. Why continue to have tight policy in an environment in which the risks are balanced?
So we do think that policy is restrictive. We think it's doing its job. I would go back to what I said in my remarks to start, which is we think the risks are two-sided. So there's a risk of if you cut too soon, the risk is that the progress on inflation will stop, or that even it will reverse. And we've seen that in some historical, particularly in the 70s. We don't think that's what's happening here at all, but that's a risk that we have to manage. The other risk is that we wait too long or move too slowly. Once we do move, and in that case, you have weakening in the labor market and economic output. So we're trying to steer between those two risks. Obviously, we're trying to be in the middle and get the timing right. It's very challenging. There is no risk-free path, but and I think we're in a position to address the economy moving in either of those directions. So the risk, though, of moving too soon really is that the economy, really does, the inflation does move up, and then it really would be quite disruptive if we were to have to then come back in. We will do what we have to do to get inflation down to 2%, but again, it's about balancing those risks. It's never the case that you can confidently look at the baseline and say, this is what we're going to do. It's always about having a baseline understanding, but then knowing what the risks are and having the committee be in a position to be able to address those should they materialize. And I think we're very much in that position now.
Maybe I can